Charles, listen, thank you so much for taking the time today to have a bit of a discussion around some adjustments that were made in the portfolio. We can see that that IBM was sold, and it looks like the proceeds of IBM were then rolled into this company Oshkosh, which I understand now is not the kids' clothing company, but much more robust than that. So maybe I'll pass it over to you, and you can sort of shed some light as to what sort of motivated that transaction and why you ended up buying Oshkosh. So I'll give it to you.
Okay, thanks, Scott. Well, IBM, yes, we sold IBM and moved it into Oshkosh. And the real reason with IBM is we looked at much higher growth from IBM, and IBM kept trundling along, and I was waiting for this major acquisition, and they bought Red Hat, which should have pushed them into a way higher growth mode. And they still are lagging the market. They're not taking advantage of the opportunity they have at Red Hat, at least until now. So that was very disappointing and disconcerting from the management's from my impression of the management. So I decided, okay, there's something better out there. So it exhausted my patience with IBM. And that's one of the reasons we do sell something, is because the reason you bought it has changed. And because of how we buy stocks and the deep dive we do, we don't change very often. But when it comes to something like IBM and their inability to increase their invested return on invested capital, it's time to go. So we gave it a shot. Now
it sounds like you're not. It sounds like you're not alone in that.
Well, it's funny too. It's funny too because I monitor a lot of the high end older people that portfolio managers in the U.S. So I've got access to a lot of information on who buys what, whether it's Dalio or Buffett or Charlie Munger, and I follow them quite closely. And it was a little interesting that Warren Buffett sold all his IBM stock.
Interesting.
And somebody made a point to Jeannie Rometty, who's the CEO of IBM, about what she thought about Warren Buffett selling the stock, and she sort of just swallowed a little bit, and that was it. And Warren went on to do something else. So it doesn't happen very often that I sell a business this way, but in this particular case, we did. And we bought Oshkosh. Now, funny, a lot of people think it's the kids Oshkosh by gosh.
Yeah, I know.
And then there's Oshkosh, Wisconsin, where they all are. So if you live in that town, people have quite a giggle about it. But the Oshkosh that we bought is a leading designer, manufacturer, and marketer of access equipment, specialty vehicles, truck bodies for primary markets, access equipment, defense, fire, emergency, municipal, and refuse. They're into e-hauling and concrete placement and airport services. And they're engineers in vehicles and equipment that move industries forward. So the products are designed, oddly enough, they're the ones that invented four-wheel drive. So the company's 100 years old. They were started in 1917. So they have major advances in mobility systems, electrification, safety, autonomous vehicles. So this is a company that's a real leader in designing specialty equipment for the Army, for the Air Force, garbage trucks, specialty custom-made trucks that can detect mines, and they're into cement lifting things, and they're into specialized fire trucks, and it's a fantastic business and a fantastic company. And they're in 23 countries, and they're expanding rapidly, but they're also expanding from the R&D point of view. And this is very important. It's like Caterpillar and it's like John Deere. Their ability to introduce through R&D, artificial intelligence, electrification of all their businesses, where they can just voicemail a truck to go into to do different things, or voice activate these massive pumping trucks that pump cement up like 200 feet and things like that. So it's really a wonderful business. Now, as we've always said, if you overpay for a wonderful business, you don't want to do that, but you don't want to underpay for a lousy business. So
right.
the business, the moat around the business and the quality of the management around the business, for the most part, is what we look at. Then we wait for the price to come to us because it's a valuation. So there are lots of businesses we love to own out there, but they're trading at 30 or 40 times earnings, and we're not going to pay that. So there's tons of businesses, but they have to come to us in a way because, as I've said before, 60% of the return of an investment comes from valuation. So the whole idea is you can't pay 50 times earnings even for Coke. If you do, you're going to have to wait years for it to catch up. So when we look at Oshkosh, and the single most important marker of the ability for the company to increase its market share is return on invested capital. It's not PE, it's not even free cash flow as much, or that, it's return on invested capital. That means when Oshkosh makes $1, they get the $1. What do they do with $1? If they make $1.02 or only $1 on the dollar, the return on invested capital is low. So we want to see a minimum of at least 10% of return on invested capital. That means the company's growing, and it's growing from a global point of view. So we have a high return on invested capital of 12% with Oshkosh. And as people know before, when we take do all the adjustments to get to what the actual profit is in a business, called net operating profit, after all the adjustments that most people don't make, then we add a cost of capital. Even if they don't have debt, there's a cost of capital to own the stock, which is an opportunity cost. So in other words, if I'm buying a company, then, okay, I could buy another company. So what's my return for an opportunity cost? So when we get net operating profit, that is after we put in a charge for the equity of the business that most people don't do. In other words, a very conservative way of evaluating the businesses that we own. So when we look at the return on invested capital at 12%, some other valuation might have that at even 15 or 16%, but because we're so conservative.
So that's really 12%,
important.
That 12% is already taken into the cost of capital. That's over and above the cost of capital.
Yes.
Oh, okay.
So this is very important, as we've talked about many times before. To buy a business, you need a barrier of entry for other companies to come in and take over your business, which is why we're not in airline companies and car companies and that kind of thing. So once we have a business that is protected by a high barrier of entry, like this one would be, then we look at, okay, how much cash did I make on the invested capital? Now, to get to that number, we have to do all kinds of manipulations in the balance sheet because of the way that the companies operate. So what we're trying to do is we're trying to reconcile the GAAP accounting with the economics of the business. So when we do that, we have to make all kinds of adjustments. When we do all the adjustments and add stuff back and take things off that shouldn't be there, we get to the absolute net operating profit. That's the real cash that came in, not a phony cash and not earnings per share. This is net operating profit. Once we get that number, then we deduct the cost of capital to that number. Even if they don't have any debt, there's a cost to the capital because there's a cost of me owning the stock for the clients.
Sure, yeah.
So the clients have to make money. So when we get to net operating profit after tax, very few people would ever do it that way because it's way too conservative. So when we're looking at 12%, 12% is net. So when we look at the next column, the free cash flow yield, that's 4%. That's 4%. That's money that they don't need. They don't need to, in the operating business, they don't need that. That's over and extra. So what they do with the free cash flow, they can do other things. They can either decide to increase CapEx. They can decide to give money back to the shareholder. So when we look at most companies from this point of view, we would never buy them. Because the secret is in reconciling the GAAP accounting to the economics of the business. So when you see a company that says, okay, we made $2 a share, they didn't make $2 a share. That's just an opinion. That could be a loss of $2. It could be whatever. So that's why we have to do the adjustments. And there's many, many adjustments you have to make. If you own the business, you would want to make all the adjustments, because then what you would want to know is how much cash do I have after everything to do with the business. GAAP accounting doesn't require in the balance sheet or whatever to do that.
Right.
So you got to stick handle and do all kinds of things and do deep dives. Most people won't do that, as we've said before, because it's too costly and too complex to have people only doing that.
Mm-hmm, mm-hmm.
So when we look at Oshkosh and we look at their return on invested capital, and we're looking at the return on invested capital is going up each year. So their NOPAT is going up each year. Their earnings are going up each year. And the return on invested capital is going up. That's what we want. So that's why we bought it.
Okay, interesting. So then the because I mean, you can see on the dashboard that you've got here that it's highlighted as very attractive, rising economic earnings, second quintile on the return on invested capital. You've got 4% on the free cash flow yield, and then the final two numbers, they're the 1 and the less than 1 on the growth appreciation years. What do they represent?
Well, the price to economic book value. Economic book value is not the book value of the business. The economic book value is the actual cash at the end of the year for the business compared to the valuation of the company. So it's not book value where you tell, okay, I've got this much inventory, I got this much this. It's actually the cash. So when it says 1, the market price, this is based on market price. The market is saying that Oshkosh won't make any money next year, any cash next year. So when we see a price to economic book value, say at 3 or 4 or 5, where a lot of companies are, that means the market is saying that the company is going to earn 300% more next year. In other words, it's a valuation marker.
Mm-hmm. Okay.
So if you look at some companies that are up at 5, the market is saying, well, you buying this stock at this price, the market is saying that it's got to grow 500% next year to equate to the price that it is, which is what the next one is, growth appreciation years.
Oh, I see. Okay. So it's saying there, like,
so you see, if you go up there and you see, well, look at the top, you say 3.5, and then your growth appreciation years of 50. A lot of businesses are up there. In other words, you'd have to hold on to the stock at the same return on capital, same growth rate for 10 to 20 years or 20 to 50 years. So if you looked at Netflix, for example, price to economic book value would be off the chart, and the growth appreciation would be more than 100 years.
Which, well, when you say that, it's interesting, because if you look on the bottom line there, I'm assuming that S&P 500 example is for the market. And it's saying that market has got a 3.0 valuation, so meaning that it's going to take 35 years to get to that point, roughly. Well,
and the reason is when you see the S&P 500, you take a look at what the tech stocks have, and the relation 12, 14, 15%, the tech stocks. In other words, if the FANG stocks went down for some reason, it would drop the S&P way faster than what the 495 other companies do. So when you saw the S&P 500 up last year, really the S&P 500 was down, except for the high growth, high business, value business, Amazon, Netflix, Apple, those companies.
Right. Interesting.
Which is why we don't want to buy ETFs, because it is so high. Now, the reason people are buying Netflix is because they think the expectation is that they're going to grow faster in Europe and faster globally than they are in the United States. Same as Uber, same as a lot of companies, that the potential and the expectation is so high that you're willing to pay the money. But then too often the music stops and there's one less chair.
Right. And then it's a scramble.
So what we do is we say, well, why do I want to bet money on a company that's trading at the growth rates are so expansive? You know, if you did that in the late 90s, people got wiped out. A lot of people in 2008 got wiped up for other reasons. So what we're doing is we're taking the contrarian view of this. You can have your Netflix and you can have your Amazon and those. And by no means am I saying that Amazon, I think, is a wonderful company run by Bezos, who's a genius. But my job is to make money for the clients.
Mm-hmm. Yeah, absolutely.
Not to agree on what my opinion is worth down the road. So Amazon is a great business. I get lots of stuff there, but I'm not investing in it, which is why we come into companies like Oshkosh.
Yeah, absolutely.
So we're going to get a sellout. You know, we're selling, lots of companies are trading 30, 40 times earnings, and there's going to be a recession. The recession down the road, when is it going to be? No one knows. Could be next year, could be the year after. But interest rates are so low that this is causing a lot of people to feel more comfortable because the cost of capital is so low. So even when we have a recession, we could have a rolling recession like we've had before, where if you were in the oil market or the resource market, you're already down 50%. You're already through your recession.
Mm-hmm.
But you don't know that because we don't have those companies, and we don't have those companies because we don't want to have the risk of that. That doesn't mean that the oil industry or the resource industry is going to start going back up now. So the idea is that because of the quality of businesses and how we evaluate the businesses, see, that's the whipped cream on them.
Right.
Because if we had a slam in the market for whatever reason with China or Trump or something, and the market, well, look what the market did even last week. It goes down. How much is Oshkosh going to get hit? Oshkosh is trading at probably 10 times earnings.
Right.
So there's not a lot of people that own Oshkosh now that if the market started going into correction, I better get rid of my Oshkosh. You know what they're going to be getting rid of, and it won't be Oshkosh. I mean, some of it, but.
Mm-hmm.
So that's the whole idea of when we started this, saying that, and why people own stocks, own individual companies versus ETFs. So we have our own businesses. So this is like our own private business. And each of your clients owns it and looks at it and says, okay, I can see it, I can taste it, I can look it up on the net, I can follow it, I can see what they do. And it's like my business. And nothing's going on in Oshkosh that is all of a sudden going to cause this business or this company to have a big problem.
You know, and that's an interesting point you bring up, because one of the things I like about the style and discipline is that you actually get to see what you own and why you own it, just like we're doing today, going through the call of discussing why it is that you decided to acquire Oshkosh into the business. And it sort of builds a bit of a sense of confidence, in the sense that, okay, well, now I understand that all the businesses that are in the portfolio, all of the securities that are owned by clients in the portfolio, there's a much higher level of quality to the portfolio when you know that each individual company went through the same sort of screening process, and it was great companies that were, identified, but then, you waited for the right price. And then when you get that right price, now, you've got everything on sale and you've got this great deal on a fantastic company. which gives a lot of that downside protection that we've talked about in past calls. So I think it's great.
Well, there's a lot, and a lot of reason is because of the way that business are changing. Is that from the investment industry, it's way easier to get an ETF and have double down ETFs, growth ETFs, all ETFs on ETFs. Sell them, charge a fee for it, and there's no individual work that one would have to do. So if you went to an investment company or brokerage firm and say, okay, I want to buy this business, I want to buy this company, what do you think? Well, who's going to do that? The research team?
Yeah, right.
So if the research team, when I look at, if you look at Oshkosh and I say we've done a deep dive and it's a big buy, there's some companies, I don't know who they are, but some companies that would say it's not a buy, some would say it is a buy. But if I had a conversation with the analyst that did it, he wouldn't do what we do.
Mm-hmm.
He couldn't because, first of all, he doesn't have the time. And for the most part, the expertise and the ability to be able to do this from a computer point of view. So if somebody went and ordered a annual report from Oshkosh or from anywhere and looked at it and it'd say it's 100, 200, 250 pages. And they started going through it and they're going to say, oh, this is what we do. And this is really fantastic. But when they look at the actual finances of the business, they won't even be able to understand it. Because what happens when they invested in a business 2 years ago and that they had to write it off because the business was bad? So they just wrote that off. Well, you'd have to go back and bring in all the deficits and everything that you wrote off. You have to bring it back in to make the calculation.
Yeah. Well, I know I've heard it before that, good portfolio managers always start reading the annual report back to front because that's where the value is in the report, all those details of what's been written off, what's been, of how to adjust the finances are all in the blue pages at the back of the report, as opposed to the glossy pages at the front of the report.
Footnotes, yeah.
Yeah.
But even with the footnotes, if you ever even try to go through one of those footnotes and through that, and you look at it, and whether you're a research guy or not, you're going to say, well, this is way too much.
Yeah, sure.
Would I have to spend a week on this? No way, buy an ETF. But when you buy the ETF, you're buying everything. You're buying the bad stuff.
Yeah.
Right. So you're not taking into consideration. It's called survivorship bias.
Yeah. Right.
So of all the businesses that have gone, well, they don't tell you that. Which is why I think your clients, they see this company, they can look it up, they can go on the net, they can get everything, they get YouTube and look at it and say, I love this. Here's the products. Here, I know these people use this, and they can follow it and they can enjoy it.
Well, Oshkosh, it's I'll look forward to seeing this one unfold. But I appreciate you taking the time and going through all the details. It's always great to get some insights when there is a transaction that takes place in the portfolio as to what motivated the transaction, and clearly we can see that there's a real buying opportunity here, and I appreciate you bringing it to everybody's attention and putting it in their portfolios. So thank you so much. Any other comments that you wanted to make, or did we kind of cover it all?
Well, only one comment. There's been a lot of money that's been taken out of the industry in the last 12 months in the U.S. So people are selling. There's a lot of people getting rid of stocks, getting rid of mutual funds, mostly mutual funds, and going into the bond market because they're scared.
Mm-hmm.
So if you really look at what's going on, the momentum of the involvement of people that own stocks and buying and selling stocks in the U.S., it seems that most of the retail clients are very worried or very concerned, which is really positive. You'd rather have them concerned than not concerned. So people say, well, the market is way too high. The market is too expensive. The market is this, the market is that. Here's the thing, that we do not own a stock market. Stock market is a concept. What we own is we want to own a business. Okay, well, what's the business? Here's the business. So whether people think that the PE or whatever of the market is too expensive, it's just a market of companies. And there's lots of companies, no matter what the stock market is doing, that are overvalued or undervalued at the same time, whether they're bull markets or whether they're bear markets. In other words, we don't want to take a look at what the market is doing and people saying the market, and this is what's going to happen in the future because of Trump or because the valuations are too high, which is why we come to a company like Oshkosh. It's not overvalued. So we don't want to have an opinion about or base our investment transactions on what we think about the whole market. I don't care about the stock market. Now, if the stock market, the more worried people get about the stock market and we get recessions, that's what we really want. That's Christmas.
Well, yeah, for
hammer the market, the market. Because if we could buy, we could buy Oshkosh at 30% cheaper, or we go up the quality ladder because the market got sold off. So it's very important that the client doesn't look at what the CNN or the social media are saying about the market. We just concentrate on our own businesses.
Yeah,
because we're business people. That's all.
Makes sense. Well, super. Well, thank you so much. I appreciate you taking the time on that. And as always, I look forward to an upcoming call.